This is Tuesday, February 18th, 2026. Silver just got chopped in half. From $121 to $61. $60 gone. Gold crashed to its 200-day moving average. Miners cut in half. The entire precious metals sector is bleeding out. If you're watching this and you're panicking right now, I need you to stop, take a breath, and watch this entire video because what I am about to show you does not make any sense. The math does not support the panic. The numbers tell a completely different story than the one the market is screaming at you. Silver crashed 50%. One of the worst crashes in modern precious metals history. And yet, right now, at this very moment, one of the most respected voices in the precious metals space for over 40 years just sat down and did the math. Back of a napkin math? Two numbers, one division. And the answer is $200 silver. Let me say that again so it sinks in. The price just crashed 50%, and the math says $200. Does that make sense to you? Does that sound like a market that is pricing things correctly? In any normal market, when an asset crashes 50%, the fundamental case weakens. The thesis breaks. The numbers get worse. But that is not what is happening here. Here, silver crashed 50% while every single macro force that drives precious metals higher aligned simultaneously for the first time in 50 years. The price went down. The case for $200 got stronger. Something is very wrong. And by the end of this video, you will understand exactly what it is. Welcome to the Market Cipher. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Drop a comment. Tell me if you are still holding silver or if you sold in panic. Whatever the answer is, by the end of this video, you will feel very differently about it. I have been covering the gold to silver ratio on this channel for months. I showed you the physical market disconnect, the vault draining, the lease rate spikes. I told you the ratio compression from 100 to 65 was just the beginning. Now here we are. Silver crashed from 121 to 61. But here is what I did not expect. I did not expect that during the worst crash in this bull market, every single macro force would intensify at the same time. The war escalating, the oil crisis deepening, the currency crisis accelerating, the physical shortage getting worse, all at once while the price gets cut in half. And that is what we need to talk about. Let me walk you through every piece of this. And pay attention because understanding this could save you from making the biggest financial mistake of your life. Let me start with the gold to silver ratio because this is the foundation of the entire $200 silver thesis. Most people do not understand this ratio, and that misunderstanding is costing them money. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, the ratio is 65 to 1. That means 65 ounces of silver to buy 1 ounce of gold. Last year, the ratio was as high as 100 to 1. It has come down, but it is still extremely elevated by historical standards. Now here is where it gets interesting. There are two ratios that matter, the mining ratio and the price ratio. And these two ratios are telling completely different stories. The mining ratio is approximately 10 to 1. 10 times more silver comes out of the ground than gold every year. That is the natural ratio based on what the earth actually produces. The price ratio is 65 to 1. Silver is being priced at 6.5 times less than what the mining ratio suggests. That is a massive distortion, a massive undervaluation. Think of it like a farm that produces 10 bushels of wheat for every 1 bushel of corn. You would expect the price to reflect that natural ratio, but the market is pricing wheat at 65 to 1 against corn. That makes no sense. Distortions this large do not last forever. They correct, and when they correct violently. Historically, the ratio has gone much lower. In 2011, it dropped to 30 to 1. In 1980, during the peak of the last great silver bull market, it went below 20 to 1. The ratio does not stay elevated during commodity supercycles. It compresses violently because silver outperforms gold during the acceleration phase of every bull market. Always. Every single commodity supercycle in recorded history. James TURK has been tracking this ratio for over 40 years. He has seen it compress multiple times. His view is that we are going below 30 to 1 again. Not back to 65, not back to 50, below 30, like 2011. The ratio compression is where the real money is made, and most people do not understand it. When the ratio goes from 65 to 30, silver does not just outperform gold by a little. It dramatically outperforms. If gold doubles, silver might quadruple. The compression is a multiplier. It is why silver went from $12 to $121 in this cycle, while gold went from $1,600 to $5,600. Gold tripled. Silver went 10x. and the ratio has only compressed from 100 to 65 so far. The move from 65 to 30 is the most explosive phase. It has not started yet. Now let me show you the napkin math, because this is where it changes everything. James TURK's gold target for this cycle is $6,000. Gold at $6,000, ratio at 30 to 1. 6,000 divided by 30 equals 200. $200 silver. And here is what makes this math so powerful. Gold was already at $5,190 before the crash. $6,000 is less than 10% above the all-time high that gold already reached in January. That is not a fantasy number. And the ratio at 30 is not fantasy either. It was there in 2011. It was below 20 in 1980. 30 is conservative based on historical precedent. 2 reasonable assumptions. 1 extraordinary conclusion. $200 silver. Right now, silver is at $61. That is a 3.3x move from here. More than tripling your money from prices available today, while everyone else panics and sells. That is why James TURK calls $61 silver the gift of a lifetime. Because the ratio at 65 heading toward 30 produces numbers most silver holders have not calculated yet. And when they do, the panic turns to conviction overnight. Let that sink in. But the math only works if gold goes to $6,000 and the ratio compresses to 30. So let me show you why the war, the oil crisis, the currency crisis, and the physical shortage are all pushing both of those numbers in the right direction simultaneously. And every piece I am about to show you makes the $200 math not just possible, but historically probable. Let me start with oil, because oil is the engine driving this entire crisis. The world consumes approximately 100 million barrels of crude oil every single day. 20 million barrels of that comes through the Strait of Hormuz. The strait is closed. The global economy is operating with 20% less crude than it needs every single day. 20%. Strategic reserves are covering part of the gap, countries releasing oil from emergency stockpiles. But reserves are finite. They last months, not years. And drawing them down during a wartime shortage is delaying the problem, not solving it. What happens when the reserves run out and the strait is still closed? Nobody wants to answer that. And here is the part most people are not thinking about. Even if the war ends tomorrow and the strait opens next week, the infrastructure has been damaged. Saudi refineries hit. Qatar LNG terminal with structural damage. UAE facilities shut down. Kuwait refineries burned. Iranian gas fields struck. This infrastructure does not repair overnight. It takes months, years in some cases. You cannot rebuild while being bombed. Even in a best-case scenario, Gulf oil supply stays reduced for a very long time. That means oil prices stay elevated far longer than the market is pricing. The damage is structural. Structural damage means structural inflation. Structural inflation means the Fed stays trapped. A trapped Fed means negative real rates. Negative real rates mean gold and silver go higher. It is a chain, and every link connects to the next. Dubai crude went from $65 to $170. If it follows the 1970s playbook and quadruples from pre-war levels, you are looking at $260 oil. I'm not predicting that, but the historical precedent supports numbers most people would consider unthinkable. And the infrastructure damage means whatever price we reach stays elevated for much longer than anyone expects. Now here is what connects oil directly to the silver thesis. When oil quadrupled in the 1970s, gold went from $35 to $850. A 24x move. Silver went from $1.50 to $50. A 33x move. Silver outperformed because the ratio compressed. The exact same compression James TURK is predicting right now. Oil shock plus ratio compression equals silver dramatically outperforming gold. We are in an oil shock right now. The ratio is at 65 heading toward 30. The historical playbook says silver massively outperforms from here, and at $61, the starting price is low enough to produce returns that will seem absurd in hindsight. Now let me tell you about something flying completely under the radar, the Japanese yen. And this is the piece that ties everything together. Stay with me, because this data changes everything. The yen is at 159.9 to 1 against the dollar, sitting right at the edge of 160. If it breaks through 160 decisively and then through 162.3, the yen could collapse to 225 or even 260. That is not a typo. The third largest currency in the world could lose another 40 to 60% of its value. Most people in the precious metals community are not watching the yen. They should be. Japan is the largest foreign holder of U.S. Treasury bonds, over $1 trillion worth. If the yen collapses past 160, the Bank of Japan will be forced to sell U.S. treasuries to defend the currency. Massive treasury selling crashes the bond market. Yields spike, the dollar destabilizes. The entire global financial system built on the assumption that treasuries are safe starts to shake. In a world where stocks are crashing, bonds are crashing, currencies are collapsing, and oil is at 170, The only asset with no counterparty risk is physical gold and silver. No bank can default on your gold bar. No government can devalue your silver stack. No algorithm can liquidate your physical metal sitting in your safe. It sits there, real, tangible, yours. The yen is the domino nobody is watching. If it falls, it takes bonds with it. If bonds fall, the dollar falls. If the dollar falls, gold and silver do not rally, they go parabolic. Because parabolic is what happens when the entire world realizes the only safe asset is the one that has been safe for 5,000 years. Now let me tell you who actually crashed silver from 121 to 61. Pay very close attention because this is the most important part. Silver did not crash because the fundamental case broke down. Silver crashed because of forced liquidation, margin calls, paper selling. When oil spiked and bonds crashed, leveraged traders got margin called everywhere. They sold silver not because they wanted to, not because the thesis changed, but because their broker demanded cash and they had no choice. The paper market liquidated silver while the physical market got tighter. Lease rates still at 12%. Shanghai still at a premium. China still hoarding. COMEX vaults still draining. The physical market does not know about margin calls. It knows about ounces. And ounces are being accumulated at every price below 70. One side is selling paper promises on a screen. The other side is loading real metal onto trucks. Which side do you think knows what silver is really worth? And the physical market is telling you the floor is near. When silver traded in the 60 to 65 range, physical buyers got extremely aggressive. Premium spiked. Dealers reported surges in demand. If silver drops to the low 50s, the physical buying becomes so overwhelming the price snaps back immediately. The physical market will not allow silver to stay below 60. Too much demand from stackers, from solar companies, from every industrial user who needs the metal. Now let me talk about the miners because this is where the biggest opportunity is hiding. And I say hiding because the market is not pricing them correctly. Not even close. Silver mining stocks got chopped in half. Names above $10 went to $5. Companies with strong fundamentals, strong balance sheets, growing production. Sold like they were going bankrupt. They are not going bankrupt. They have never made more money in their history. Silver at $61 with mining costs at $15 means $46 profit per ounce. Record margins. And the stocks are at half price. A miner producing 10 million ounces at $15 cost with silver at $61 generates $460 million in annual gross profit. Some of these stocks trade at market caps less than 3 years of that profit. In any other sector, they would be at 10 to 20 times earnings. Miners are at 3 to 5. The disconnect is absurd, and dividends are rising. When a company raises its dividend during a crash, it is telling you the profits are real and the management is confident. Now, there is a valid concern about oil squeezing miner margins. Oil at 170 means higher energy costs for operations. But for oil to actually squeeze margins back to historical norms, it would need to be at $200 with gold at $2,500. Gold is above $4,000. At current prices, miners absorb $170 oil and still generate extraordinary cash flow, and the overvalued sectors are cracking. Tech stocks bleeding, the AI bubble losing air. When capital flows from tech into the most undervalued sector in global equities, the re-rating in precious metals miners will be violent to the upside. Let me connect all of this together because I have thrown a lot of data at you, and I want you to walk away with total clarity. Oil shock creates inflation. Inflation traps the Fed. Negative real rates drive capital into hard assets. Hard asset demand compresses the gold to silver ratio. Ratio compression multiplies silver returns. And a yen collapse could trigger a bond crisis that sends the world scrambling for the only asset with no counterparty risk. Every force connected, every force active, all at the same time. This is the first time in 50 years, and the prices are the cheapest in months. That combination does not come along often. It does not last long when it does. Now, let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. I'm going to be very direct. No sugarcoating. If you're holding physical silver, do not panic. I repeat, do not panic. Your entry price does not determine where silver goes. The ratio does. The oil crisis does. The physical shortage does. All three say higher, much higher. The crash from 121 to 61 erased 8 weeks of gains, not 8 years. The bull market that produced those gains is still intact. Hold your metal. Do not be fooled. If you're holding mining stocks, look at the cash flows, not the stock price. Record margins, rising dividends. These companies are more profitable than at any point in their entire history. The stock prices are lying. The cash flow statements are truth. If you're looking to buy, dollar cost average. James TURK has advocated this for decades, not trying to time the exact bottom. Consistently accumulating. Building your position systematically. Taking the emotion out. Being positioned matters infinitely more than being precise about the entry. And here's the paradox that will blow your mind. The lower the price crashes, the stronger the case for $200 becomes. Lower prices create more physical demand. More demand drains supply faster. The crash is accelerating the path to $200, not delaying it. Some people will say $200 silver is fantasy. They will say the bull market is over. To those people, I say, look at the evidence. Gold bounced off the 200-day moving average. Major trend up. Ratio at 65 heading to 30 where it was in 2011. Mining supply 10 to 1 versus price ratio 65 to 1. Miners at record margins with rising dividends. Oil at 170 with structural damage lasting years. Yen at 160 on the verge of collapse. Lease rates at 12%. Every fundamental force on the planet aligned. That is not fantasy. That is data. That is math. That is reality. Now, there are three types of people watching this video right now. The first type is scared. They see silver cut in half and they want out. They are sitting on losses and the pain is real. Fear is making every decision for them. The second type is confused. They see conflicting signals. Price crashing, but fundamentals strengthening. Miners profitable, but stocks halved. They do not know what to believe. They are paralyzed. The third type understands. They see the crash for what it is, a paper liquidation event in a physical bull market. They see $61 with a mathematical path to $200. They see miners at half price generating record cash flow. They recognize this moment for what it is, not a crisis, the gift of a lifetime. Which type are you? Let me leave you with this. Silver crashed 50%. During that same crash, the ratio math got stronger. Gold held its 200-day. Miners hit record margins. Oil stayed structurally elevated. The yen moved closer to collapse. Every fundamental intensified. While the price got cheaper. The price went down. The case went up. One of these is a lie, and it is not the math. Gold is your 747. Steady. Reliable. It will get you there safely. Silver is your F-15. Fast. Volatile. Terrifying at times. But when it moves, it covers more distance in less time than anything else in the market. And right now, the F-15 is fueled up on the runway. The conditions for takeoff have never been better. James TURK says $200 silver. The math is simple. $6,000 divided by 30 equals $200. And $61 is where you get to decide which side of that equation you want to be on. This is what a gift looks like. And now you know the math behind it. Subscribe if you have not already. Hit the notification bell so you do not miss what comes next. Drop a comment with your silver cost basis and tell me if the ratio math changed your view. Share this video with every silver stacker you know because they need to see these numbers. I read every single comment. This is the Market Cipher because the real story is never on the surface. I will see you in the next one.